Hello, welcome to the channel. So in today's video we are going to cover the concept relating to hedge accounting. So let's have a look. So first of all, before knowing hedge accounting, let's understand what is the meaning of this hedge. So we have already studied this hedge accounting in the risk management. So hedge, what is this hedge? Hedge means reducing the risk. So it is a type of contract where we are trying to reduce our risk, that is called as hedging. It is a process of reducing the risk. So in the chapter derivative we have already covered this term, that is hedging. So in the last semester subject, that is risk management, I have clearly explained the meaning of hedging. Now let's understand what is this hedge accounting. So for example, before knowing the definition, this is a simple meaning we can easily understand. So here, designating one or more hedging instrument so that their change in fair value is an offset to change in fair value or cash flows of a hedge item. Now what is this hedging instrument and what is this hedge item? So for your easy understanding, there is one example from www.ifrsbox.com. So for example, there is one producer who is in US. So there is one producer, one company which is located in US. So this US company wants to expand its business. So they open one branch in European country. So they have opened in some branch in European country. Now they sold some of the items to the European customer. So from US, some quantity of the products are being sold to the European customer. So here the European customer and the US producer enter into one contract that after 9 months the European customer will pay 20 millions European currency, 20 million the European customer will pay to the US producer. Now the US producer is fear of the foreign exchange risk. So the US producer, he fears that after 9 months the 20 whatever the amount which is payable by the European customer, that foreign exchange rate may decrease. So the US producer is fear of the risk of the foreign exchange rate. So what he will do to save himself from the foreign exchange risk, it will enter into contract with the bank. So this contract is forward contract. What is forward contract? Forward contract, it is a kind of contract where you're aiming to purchase and sell some goods at a specific period, at a specific date, at a specific price. So the US producer will make a forward contract with the bank. What is this contract means? After 9 months, when the European customer pay the $20 million to the US producer, the same $20 million at a specific rate fixed today, that is the rate here fixed is 1.28. So at this rate only the bank has to convert the amount and pay back to the US producer. So here this is the rate fixed by the US producer. So this is the current rate he wants after 9 months also, because he is feared that after 9 months the rate may decrease, the foreign exchange rate may decrease. So here he is making a forward contract for 9 months to receive the 20 million European currency for 1.28 US dollars. So here what happens after 9 months? So after 9 months the European customer will pay the $20 million. So US producer receives $20 million from the European customer. So after receiving this $20 million, the US producer will give this amount to the bank. The bank will convert this amount into 1.28 US dollars and pay back to the US producer. So here, because of this contract, the US producer is safe from the foreign exchange risk. So whatever the changes, variables that could be happened in the duration of the 9 months, that is saved by this forward contract to the US producer. So here the hedging item is the products of the US producer, and the hedging instrument is this forward contract between the US producer and the bank. So now let's look into the definition. So designating one or more hedging instrument. So here it can be one or it can be more than one. So a US producer, he can enter the contract with one bank or one or two banks. So that change in the fair value is an offset. So offset means we are it is a kind of second option to save the things. So here it is offset to the change in the fair value or the cash flow of the hedge item. So here the prices of the hedge item, that is the customer's product, the price, fair value, cash flow, it can be the price of the products or it can be the cash flow. If there is a change or there is a variation in the fair value, you can enter the contract with one or two hedging instrument, and you can save the money from the hedging process. So this is called as hedging and hedge accounting. So IAS 39 covers all the hedge accounting concept. So this is all about the hedge accounting. If you have any doubt, you can ask me in the comments below. So there is a definition of hedge accounting also. Let's have a look. Hedge accounting is a portfolio accounting method that combines the value of both a security and offsetting hedging instrument. So here portfolio means more than two investments. So a basket of investment, we can say a basket of investment. So here hedging can be used for any kind of investment. It can be used for any kind of investment that combines the value of the security. So here security means, in the example, it was the products. It was the products, and the offsetting hedging instrument here, what it was the bank. So here it is covering both the changes in the value of the prices of the product or the cash flow, and also the fixed return, that is, in the example it was 1.28 US dollars. So it is covering both the cash flows, variation in the cash flows of the product, and also the bank is providing the fixed US dollars to the US producer. So US producer is saved from the foreign exchange rate risk. Thank you. If you have any doubt, you can ask me in the comments below.